to our Eastspring studios. Today we're very privileged to have Ken Wong, who is the product specialist for our Lipper award-winning China fund. Ken, thank you for making the time for us. Now, I've got to ask, we started off in September last year and we saw the Chinese market rally. At the end of the year we hit a brick wall, and we're now some 13 to 40% off. What actually happened? Did the GDP figures have any effect on this? Just what was actually going on here?
Well, we think what happened was that the market took these poor economic readings as a reason to actually sell out in some of their gains that they had over the past quarter. If you look at Q4, was a fairly good quarter for the Chinese equity markets. So, and obviously we had 5 consecutive months of strong performances from September all the way up to January and February of this year. So having slightly lower than expected economic readings was a good way for investors to actually start taking some profit as an excuse to take some profit in the markets.
But that seems to be an ongoing process, because over the last day or two we've actually seen some shaky PMI figures, and we've seen investor confidence again be knocked by that. So the point I'm grappling is, at what point does the market stop pricing in the perception and it starts pricing in the reality?
Well, we think that the markets are getting closer to pricing in things a little bit more closer to reality. But the good reason behind this is that valuations now are much lower than they have been historically over the past 10 years. Expectations have also been dialed down. We've seen 24 months of downgrades from the sell side, and we have started seeing some of these revisions bottoming out, and EPS growth number doing slightly better. So we think at this point in time, actually, the numbers are actually getting more closer to the lower point, and there's definitely a greater margin of safety for investors in the Chinese equity markets right now.
So basically, the message I take away from this is that your concern over the past 2 years that the earnings forecasts were just too aggressive and not believable, that seems to be washing itself out of the system.
Correct.
So in other words, you think that the apparently cheap valuations that we see today really are cheap. It's not an illusion.
Exactly. They are cheap because they are one standard deviation cheap based on sort of where the markets happen. Markets were trading more closer to 12.5 times PE over the past 10 years, where markets are now trading at closer to 9 times PE. So you definitely do see where the markets are trading much more cheaper than it has before.
But this is sort of a dichotomy, really, because over the last year, the value across Asia, and presumably in China as well, seems to have been in the cyclical stocks. And yet the investors have gone and chased the non-cyclical stocks, such that valuations now, the valuation gap between the two, is nearing their historical wides again. So what actually is sort of going on here?
Well, what's happened is that some of the cyclical stocks, and again, some of the consumer names that we've seen in the marketplace, was derated last year, and they've also derated again this year. Obviously, some of the same sort of sales growth numbers were slightly lower than expected. Earnings came in more towards the lower end of guidance, and also what we had was with lower earnings expectations, the markets didn't perceive that too well. So what happened was these companies derated, and what you also got was the fact that these stocks became quite attractive, and this is where there are a lot of opportunities in some of these sectors for investors to take advantage of.
This, again, sort of raises as many questions as it answers, because if we'd been having this discussion 2 years ago, it would have been roughly the same discussion and the same points being brought up. We've got stocks that have been cheap now for 2 years. What's going to break this? What are you looking for that is going to actually signal to you, hey, we're out of this period of range trading, we're off to the races?
Well, I think at the moment what you see is that expectations are a bit low. And what's happened is the fact that there is still some uncertainty, sort of what's going on in China, from a political point of view. What we've seen is that everyone is expecting for the government to start having various forms of reforms, whether it be state-owned enterprise reforms, banking reforms, potentially tackling corruption with anti-corruption. These are all going to be important things, but unless investors see a more finer blueprint on what the central government will do about these things, on how to tackle it as China moves sort of towards this next phase of the economy, investors will still give a discount to the Chinese stock markets. So only when these things start to happen will you expect actually for the markets to re-rate. And again, this isn't going to be a 1 month or 6 months or a 1 year thing. This is a 2, 3, 5 year type of process when we talk about reforms. But when these things start to happen, that's when you will start to expect investors to price things slightly different for the Chinese equity markets.
So basically you're saying this is a good opportunity to position.
Correct.
Ken, I think we're running out of time. In one short, succinct sentence, is there any basic message that you want our investors to go away with in relation to China?
Yeah, I think as I mentioned, over the past few minutes, China, what's happening right now in China? Well, within the stock markets, you have low expectations, low valuations. You do have some uncertainty in terms of what will happen with some of these reforms, but we think actually this is a very good recipe, for investors to take advantage of the situation and to start having, more investments into Chinese equities.
Good, thank you very much. Ladies and gentlemen, that was Ken Wong, who is the product specialist of our Lipper Award-winning China Fund in our Eastspring studios today. Thank you for watching.